A person sits at a table with a modest stack of coins in front of them. A second, much larger stack sits just out of reach. The gap between them keeps growing. Most people borrow money expecting to pay it back quickly. But debt has a quiet mechanism built inside it. It grows on its own, even while you sleep. This mechanism is called interest. It is a fee charged on the amount you owe. The longer you owe it, the more the fee adds up on top of itself. When you borrow 100 units, you do not just owe 100. You owe more each month. The original amount barely changes if you only pay the minimum. The minimum payment is designed to keep the debt alive. It covers mostly interest and very little of the original amount, so the balance barely moves month after month. This is why a small loan can take years to clear. The debt does not disappear at the same speed you pay it. It resists being reduced until you pay above the minimum. And here is something most people do not realize. As you pay off one debt, the interest from what remains continues to accumulate underneath, quietly and persistently. There is a reason lenders prefer borrowers who pay only the minimum. The longer the debt stays open, the more total interest the borrower pays over the full life of the loan. This is not a conspiracy. It is simply how the math works. A longer repayment schedule means more time for interest to accumulate on the remaining balance each month. Now think about what happens when a person carries more than one debt at the same time. Each one charges interest. Each one demands a monthly payment. The total outflow grows fast. Multiple debts create a layered drain on monthly income. Even if each individual payment seems manageable, the combined total can consume a very large portion of earnings. Economists call this the debt service ratio. It measures how much of your income goes directly to paying debts before you can spend on anything else at all. When debt service exceeds roughly 30% of income, most households begin to feel genuine financial strain. Choices narrow. Savings slow down or stop entirely. What makes debt especially persistent is something called compound interest. The interest you owe is added to your balance. Then next month, interest is charged on that larger balance again. This means the amount you owe can grow faster than your ability to pay it down, even if your income stays the same. The math begins working against you at a certain point. Many borrowers do not realize this tipping point exists. They see only each individual monthly payment, not the total amount they will pay over the full duration of the loan. Consider a simple case. Borrow a moderate amount at a common interest rate and pay only the minimum each month. Over time, you may pay back nearly double the original amount borrowed. The lender collects the interest. The borrower paid for the use of money. This is not inherently unfair, but most borrowers never calculate the actual total cost before they agree to borrow. Debt also has a psychological dimension. Once a person is used to carrying a balance, the idea of being fully debt-free can begin to feel abstract or even unnecessary to pursue. Behavioral economists call this debt normalization. When a payment becomes routine, it loses its weight as a cost and simply becomes part of the monthly landscape of spending. And here is the counterintuitive part. A person who always makes their minimum payments on time is considered financially responsible by most lending systems. Yet, they may still owe more than when they started. If you are finding these explanations useful, this channel continues to break down the economic mechanisms that shape everyday financial life. Subscribing means you will not miss the next one. There is another layer to debt that many people never see. When a household takes on debt, it is making a promise about future income. It is borrowing against money not yet earned. This means that unexpected events, like a job loss, a medical cost, or an economic slowdown, can break the assumptions the debt was built upon. The future income does not arrive as planned. When future income does not arrive as expected, the debt does not pause. Interest continues to accumulate. Penalties may be added. The balance can grow faster than ever during exactly this moment. This is why financial advisors emphasize emergency funds. A small reserve of savings can cover several months of debt payments if income disappears, preventing the balance from spiraling further upward. Most households do not have this reserve. Studies consistently show that a large portion of working adults could not cover 1 month of expenses from savings alone without taking on new debt. So when an unexpected cost arrives, the response is often to borrow more. A new debt is added on top of existing ones. The layers compound in the same way interest compounds on a balance. Each new layer of debt brings its own interest rate and its own repayment schedule. Managing multiple debts with different rates and timing is genuinely complex for most ordinary households to navigate. Debt consolidation is often proposed as a solution to this complexity. It combines multiple debts into one with a single payment. But if the new interest rate is not low enough, the total cost may actually increase. There is also the extended term problem. Consolidating at a lower monthly payment often means extending the repayment period. A longer period means more months of interest charged, raising the total amount paid. This is the core tension in debt management. Lower monthly payments feel like relief, but they often extend the period over which interest accumulates, making the long-term total significantly higher. Debt also affects behavior in ways that extend beyond finances. Households with high debt levels consistently report reduced spending on health, education, and maintenance. These delays create their own future costs. A small maintenance issue ignored becomes a larger repair. A skipped health visit becomes a more expensive treatment. The debt does not just cost interest. It costs the avoided investment in everything else. At a larger scale, economies carry debt too. Governments borrow to fund services and infrastructure. When that debt grows faster than economic output, the same compounding pressure begins to apply nationally. When a government pays more in interest than it collects in new revenue, the debt grows automatically. It does not require new spending to increase. It simply expands because the old balance remains unpaid. Countries with high debt, relative to their economic size, often face rising borrowing costs. Lenders begin to charge more interest because they perceive a higher risk of the debt not being fully repaid on time. This creates a reinforcing loop. Higher borrowing costs mean more interest expense, which increases the debt further, which raises perceived risk, which raises costs again. The cycle is self-reinforcing once begun. This is why debt reduction policies are so difficult. Paying down debt requires either more income, less spending, or both at the same time. Each option has real costs that affect people and economic output directly. Some economies have successfully reduced high debt over time through sustained growth. When the economy grows faster than the debt, the ratio improves without requiring the original amount to be fully repaid. But growth cannot be assumed. Economic slowdowns, recessions, or external shocks can interrupt the growth that debt reduction depends on. The debt remains even when the growth does not arrive as expected. This is why debt is described as persistent. It does not respond to hope or intention. It responds only to actual payment above the interest level. Everything else leaves the core balance essentially unchanged. Understanding debt as a persistent mechanical system rather than a temporary inconvenience changes how people approach it. The borrower who understands compounding makes very different decisions than one who does not. The same compounding logic that grows debt against you can work in your favor when applied to savings. Interest earned on saved amounts also compounds. The mechanism is identical, only the direction changes. Debt never simply disappears on its own. It waits. It accumulates. And in every household and every economy that carries it, its quiet weight is always already pressing against the next decision.